Good afternoon, I'm Ross from Crimsmith 150 Group Property Accountants, and today I'm going to talk about structures, terrible business structures. These are a few common examples and a few of the problems with them. So hopefully this will just be a couple of minutes. If you've got a business, really worthwhile watching through this, see some of the examples of structures and why they're good or bad. So unfortunately, we still get the structure every now and again. You're in business, you're running a reasonable sized business. Say you're a plumber, you've got 5 staff, and you're running the business through your personal name, you're a sole trader. To me, this is terrible. You're running your business. Maybe you've got some long-term rentals and maybe you've got a personal house. So in this case, if the business goes bust, the business is you as an individual, you're personally going to get sued. You also own your long-term rentals. Potentially creditors are going to get access to those and any other assets that you might have. Your personal house could be at risk from creditors as well. So there's one big problem we've got. We've got no asset protection, all your assets at risk. It's not a good structure from a business point of view, from that point of view. And from that perspective. And obviously, we concentrate on rental properties, and we don't really want the rentals owned by a personal name that owns the business, because like I said, business goes bust, personal name goes bust, you lose the rentals. That is not a good structure. So that's number one. Number two, personal name, most likely that individual running his big plumbing firm is hopefully going to be making some good money. And if his rentals are also making him or her, the plumber is making a really good profit, they might be getting some rental profit down, and that's also be getting taxed at 39%. So from point number two, a tax point of view, it's not a good structure. And then we've got some added issues. Say that this plumber rents out their personal house it's just in the individual's name and they rent it out Airbnb. They're GST registered for their business, which is their personal name. Their personal house is also in their personal name. So suddenly they rent out their personal name for GST and for Airbnb, and we have a GST issue. So there's 3 problems with that structure to start with. To me, it's just a terrible business structure. If you've got any sort of health and safety risk, any sort of reasonable business, you don't really want to be a sole trader, and this is a pretty bad structure. Hopefully most people have got past that and got into a little bit better structure. This is another really common structure. So instead of having the business operating as a sole trader, it's operating as a normal company. So most people at this stage think, awesome, we're paying tax at 28%. That is great. But that's an interim tax. So say this business makes 200,000 and the individual running it wants to get all that 200,000 out to them, and they want to spend it buying a batch, paying off their personal house, personal spending, whatever they want to spend it on. Well, the 28%, if it's a normal company, is only interim tax. If they move all the 200,000 down to them as individual, either as a salary or dividends, they're going to be taxed at their tax rate. So 200,000 pushes them into the top tax bracket, so they'll be taxed at 39%. So again, the structure is not that good. They're starting off at 28%, but they're still looking at 39%. Say this business gets sued. In theory, then the rental should be separate, the personal house should be separate, and the personal name should be separate. But in reality, what is going to go wrong with a business these days? Could it be something like health and safety? If it's health and safety to do with the business, it might actually be the person who's actually in the limelight. They might be the one getting a huge fine or getting sued or whatever it is. In that case, the rental company is owned by them. It's their asset, so they could lose that. Personal home in their name, potentially they could lose that. This has got a couple of problems again. One, tax, 39%. Asset protection, it's a little bit better than the last one, but still not amazing. And then we're talking a normal company for rentals. This is a big no-no to me. If this has a number of rentals and we make a big capital gain, they sell a property off after years and years of owning it, tax-free sale, get a big capital gain and they want to bring it down and pay off the personal house. If it's a normal company, that can be really hard. It can be just about impossible to do it. So yeah, be very careful with normal companies. Capital gain is stuck within the normal company. It's not the individual. So you need to be very careful. And the only way to get the capital gains out is to liquidate. If there's 4 other properties, very, very hard to liquidate. You can't liquidate. So yeah, to me, the structure's got lots of holes in it as well. And yeah, it's not really a great setup. Little things you could do if money is loaned to the business, you could do it with formal loans and something like a general security agreement. That would help protect the investment in the businesses a little bit, but yeah, it's still not ideal. So to me, if you've got these sort of structures, yeah, they're not ideal. You've sort of gone some of the way, but there's perhaps better. I've seen people like this who have, yeah, their personal house in a trust, but haven't looked at the rest of the structure. So if you've got a trust and you've got a setup like this where your rentals and your business are actually owned by personal names, lots of improvements, lots of things we can do better. And if you've got a reasonable business, especially if there's health and safety risk and you're running it through your personal name, to me, you've got issues and you should both to improve that. So hopefully you enjoyed that. Hopefully it's given you something good to think about, and watch out for our blog coming out in the next couple of days. I think we've got about 5 different examples of when a property transaction could be taxable, some sort of case studies, common mistakes around that. So you might enjoy that, some around subdivisions and things like that. So yeah, thanks a lot, and hopefully you enjoyed it. Thank you. Bye.